All right. Good afternoon. This is the Credit and Collection News Podcast. We've got our usual cast of characters that are with us today. John McNamara, Stefanie Jackman, Joann Needleman, and Rob Grafrath. The group, we're going to talk about some stuff that we've briefly touched on in the past, and we're going to talk about some new stuff that's happening within the industry because we all want to know what's happening with the group. So why don't we go ahead and get started, because that's why people are listening and watching. Let's talk a little bit about our friends at the CFPB. It looks like they have a new plan that's going to leave the CFPB in place. It's going to take the agency to somewhere around the 500 employee level. Supposedly, this is what's coming out from each side. I don't know if everybody's happy or if everybody's just mad and they decided this is what we're going to do to compromise. So, since we have a former CFPB person with us, let's start with John and go from there. And let's chat a little bit about what's going on with our friends there. John, take
Sure.
it over.
Yeah. Hey, thanks, Steve. So it's not over. It's not over yet. But it feels like it's getting to into the overish stage. The You may recall some of the earlier podcasts. I talked about the fact that this may come down to a CFPB of. I think I was hoping for a CFPB of 700 because that would be the upward bound of what they could afford with the 46% budget cut from the One Big Beautiful Bill Act. Um, so there was a reckoning they were going to have to face too, because eventually that was congressional intent. This 554 person plan, it shocked me when it came out. It was shocking, but not unexpected. I guess if that can make any sense. And my first reaction was sorrow at the dismantling of this regulatory agency that I spent 12 years at, and it has so many good people. But also, I'll admit, I'm a capitalist. I'm selfish. Not selfish. I just like making a
You
buck.
have to be selfish to be a capitalist, John.
You're exactly right. You're exactly right, Joann. And I absolutely will take that back. But I was like, okay, but the capitalist side of me, as opposed to the hard charging consumer advocate side of me, is like, wait a minute, this is bad for responsible industry because cutting enforcement to like 50 people and supervision to 77, that is just waving a red flag at the bulls that are the states that want to step in, inviting them to step in. So that sadness and horror at that. And at the same time, a modicum of solace in the fact that my old markets group actually will probably have to hire somebody. I think they were being cut to 20. They were losing two people anyway. That one was the last fellow rolled off from the CFPB in April. So that group is preserved. And I think that's good because that's good for responsible industry, because getting people that actually know an industry inside and out and really well, and that have the humility to engage with industry and learn from them, devilishly hard to hire. Because when you go through the federal hiring process, the early bureau had exceptions to bring people in. Like Johnson Eddy, I think, was hired under an exception. It was fairly easy to get them. It became progressively, everybody had to go through the normal hiring thing where almost damn near impossible to get anybody. So there is that. But I say it's not over when I started, because we still you have the DC, the DC appellate court in bank is ruminating over this, I assume. Sometimes they'll ruminate for over a year. You have the request to send the matter back to Amy Berman Jackson to make a decision. And then lastly, I'll say, hey, this was Doge at its best. I mean, if they'd done a proper, legal, lawful reduction in force, they could have been at this number or somewhere in that neighborhood a year ago, and for a lot less money, a lot less lawsuits, a lot less heartache. So it remains to be seen. But everywhere I've looked, Doge has actually wasted the taxpayers' money. It was just absolutely an unmitigated disaster. And it's absolutely a painful gift that just keeps on giving. And that's just what we know so far. I think it should dig more into it. Everything Doge did was done in a shoddy, sloppy fashion. But I guess that's what you get when you turn over the keys to all of that data, all of that process, all of those years of institutional knowledge to a 19-year-old named Big Balls.
Well, you know, a 19-year-old named Big Balls definitely sounds like that's the person that you want to run everything with.
Is that
So,
name on his birth certificate? I mean, my God.
hey, or if it's a nickname, then you know what, you're gonna go with it because
Right,
it works in bars, I suppose. Stephanie, your comments on this? I mean, you're a mountain climber. Is this a mountain climbing type thing where we've got to go over and look at it all?
Not just me. Many of us said it 8 years ago. Many of us said it again here. CFPB is not going anywhere. It may change. It may evolve. It may get smaller, be more streamlined in accordance with the priorities of whoever is at the helm and whoever's in the White House. But it's not going anywhere because it can't. And I agree with John. I think there was a desire to have a lot of theatrics, and it's ultimately been exceedingly wasteful and got us to exactly where, even when Mr. Musk was waving a chainsaw on stage, so to speak, where many of us on this side were, which is the CFPB is not going to cease to exist. So, to me, this has just been tiresome the last 18 months.
Yeah, like really bad policy theater. But it's so bad you can't turn your eyes away from it.
I mean, it was unlike anything I've seen
cringeworthy.
before.
It's totally cringeworthy. For
And
sure.
in the industry, as the people being regulated, and we're begging for them, no, we want to have a federal body regulating our industry because, right, what's the alternative? And then it turns over to the states, and then they go crazy on us.
And one
No,
point
please.
too that this scares the bejesus out of me. I think folks convinced, and I think folks were looking at maybe the senior leadership of the Bureau under Chopra. They were looking at Rohit and a handful of his people. And I think folks at the White House concluded that the entire Bureau was just full of toxic people that had to be just wiped out. And that could not be further from the truth. It is absolutely chock full of dedicated technocrats that know their skill. They have decades of institutional knowledge. They absolutely sort of follow the law and aspire to follow the law. And in many cases, actually, we had little respect for Rohit and his crowd because they showed far less respect for the law. But what I fear is the treatment by vote of these very good public servants may have radicalized a lot of them. It would hard. I mean, listen, I'm a capitalist. I'm a middle of the roader. But if I'd been hanging in there with my former team and my friends at the Bureau, it'd be very hard not to be radicalized and so fired up that when there is a change in administration, you just want to come in womping on anybody that looks like they liked or posted or said anything positive about Elon Musk and Russell Vought and the tactics that have been employed.
Yeah, we are going to see retribution wrought for exactly those reasons. And John, we saw it already, right? After the end of the last Trump administration, followed by the Biden administration, you had this sense, or at least my perception was that we're picking our agenda up right where we left off in 2016, 17, and putting aside regardless of Director Kraninger's leadership and whether it actually was, I've said I think she has shown the type of leadership that I think is appropriate for that bureau in showing a desire to continue the mission of consumer protection. Because I've heard from members of the bureau, our job is not. I mean, John, I think you even said it at an industry conference years ago. Our title is not Consumer and Industry Protection Bureau, it's Consumer Protection, but in a way that wasn't as fully politicized as I feel, at least right now, and under the prior leadership with the Biden administration. It's just been fully politicized, and I think that really degrades the important mission of the Bureau that there is a place for, that many, many, many members of the industry agree there's a place for. And states right now are really scrambling to pick up the the sword and continue going forward in ways that are really challenging, because we're seeing many of what the Biden administration's CFPB priorities were being transported to states and pursued there. So we're still facing the same issues, arguments, risks, because these are big states, California, New York, Massachusetts, right? There's others. We're still having to fight those battles. And I just think that in a couple more years, we could have whiplash back, where whatever traction they're getting in those states, or if there's litigation or whatever it may be, you could have a CFPB that jumps on board again. Maybe not. We'll see, because I don't know what's going to happen with the midterms, let alone the next presidential election. But this is not good for anybody. This is causing uncertainty, unevenness. That's bad for consumers. It's causing states, I think, sometimes to make decisions to consider opting out of DIDMCA and maybe not thinking it all the way through, because they're just so focused on protecting consumers in a way that they think is necessary, and that they have sometimes, I think, substituted their judgment in place of many experts that work across not just the CFPB, but consumer advocacy groups and industry groups on what is realistic and what's actually workable. And I think that's going to ultimately harm consumers.
Oh, 100%, Stephanie. And I think I've said it before, and I'll say it again. Like, if my health is good, and when there's a change in administration, I would love to pull in every favor I've got to come back to the CFPB to urge moderation. And there is little or no need for retribution. Now, will I wind up like the marching band director from Animal House, an obscure movie reference? Probably, but I want to make that effort to urge fact-based, calm, rational, dispassionate regulation and rulemaking, which is what we should have had all along. And it really went off towards crazy train. The crazy train sort of left the station under Rohit, and it's never come back, because vote has continued it, just in a different direction.
And kind of what Stephanie was saying, what's good for the consumers and what's good for the industry, those don't have to be at odds with each other. The two can coincide. We can have a healthy, well-regulated industry with a responsible regulatory body. We want this. We want a level playing field. We don't want the bad guys to be able to get away with things because now the CFPB doesn't have time or energy to chase them down. Because then we're like, well, we can't compete with companies that are cheating, right, to win. So, and then, okay, yeah, here comes the states.
Well, I think all these are, I agree with what everybody's saying, but the problem is Congress. And if and when Congress decides, and so that's my theme through many of these podcasts, to grow up, and I'll put an expletive in front of that. John, I'd love you to go back to the Bureau. At least I know someone I could call and have a conversation with. But the problem is you're going to go in with the best intentions. But, and to the extent that those people are still at the Bureau or going to come back, all those people had the best intentions. 80-90% of the people at the Bureau, to your point, were good people who did good work. The problem is the politicos. And whether it's going to be on one side or the other, the politicos are going to run it. There were opportunities after Cordray and after the whole blow up with, what was her name? The secretary who became the director for about 30 seconds. I forget. Deandra English. Yes. There were the Republicans.
Leander.
What the Republicans could have in 2016 easily, with having the majority in the House and the Senate, turn the CFPB into a commission, structurally change the Bureau in ways so that we would not be here 10 years later. But here we are 10 years later, and it's never going to change because Dodd-Frank and Title 10 is poorly written. And until Title 10 is fixed, to the premonition of what Stephanie just said and what you just said, it is going to be worse, because we all thought it couldn't get more worse than Cordray. I think I would ask everybody on this call. I'd have Cordray back in a minute. Cordray understood process. Cordray understood
Amen.
hierarchy. He also knew he was a politician, and he knew sometimes when the dice should be rolled and when it shouldn't. And
But
when
Cordray absolutely respected the rule of law. And
well, I don't know. PHH would agree with you on that. I do not think PHH would agree with you on that.
Yeah, I'm not going to die on the PHH hill. I just wish markets had been. I wish I had been there for that discussion on PHH.
Okay.
But no, I mean he many
You heard
times
it here first. PHH would have never happened if John was there.
and all of those.
Let's get that on the record right now.
It's like, do you really want to go from this to like that?
Well, let's. I get it, but my point
it looks a bit imperious.
Right. When you had Raj Date and Cordray, you had a lot of smart people at the top there who were pretty well educated and who were from industry. And you knew how to kind of analyze the odds on certain ways. Look, Cordray knew that open banking was something he didn't want to touch, but he did enough to kind of ease it along. It was going to
the data principles, I think, were largely formulated. And you know what? The data principles are still being used. I mean, they made sense, and they were good for industry and ultimately good for consumer, because they ushered in like products like Rocket Money and the ability to quickly get loans when you need money.
Right. But understand that, and to the point that everybody has made, the CFPB ultimately was set up because we had obviously we had a mortgage crisis, but it was about the fact of what was going to be the regulator for non-banks. Was it going to be the FTC? Did they have the capability? They didn't have rule writing authority on certain statutes, as we know. And that is really critically important. And no one in Congress seems to understand that. We can't let the mortgage markets go nuts. And let's think about it. We can hand wring about the CFPB as much as we want, things that we didn't like about them during COVID, but for the infrastructure that was built around mortgages, banks survived during COVID, which under any other circumstances, if we didn't have that infrastructure, would have been a disaster. So, I think that I'm hopeful, but I'm not optimistic. I agree that, come whatever's going to happen in a couple of years, the CFPB is going to turn. It's going to be worse than it ever was. And that is a shame for everybody, for all involved. It has just been a political football, as we've all talked about. But, someone needs to step up, put their big boy pants on and figure out, how to integrate this agency with the rest of the financial services agencies that exist. I will say, though, and I'm sure you all have seen this, I have noticed that the OCC and even the FTC have been pretty aggressive lately on consumer protection issues. We just saw what the FTC came out with their strategic plan, which is going to cover debt collection, credit reporting, everything else. They're going to use economic data in a lot of their enforcement actions, basically saying to potential targets, you give us the data and you give us in a nice little package with a pretty little bow, because we want to analyze it to ensure that there has been actual harm to consumers. The OCC has come down with a couple consent orders, one for the, I think, Federal Bank of Chicago, and another one in Virginia regarding service members. There were consumer protection violations at these banks. So, I throw it out there. I think it's a lofty premonition, but is there a new world order coming where some of these agencies are going to pick up the slack of the CFPB, at least for right now? Don't shake your head so fast. And so when the Bureau does come back, is there going to be, will the argument then be made, why do we need the Bureau to do all these things when we have these agencies who are doing them already? It could be. I mean, I don't know whether that's intentional. I don't know whether it's by design, but watch out for the FDIC and the OCC and the FTC. I think that they are going into areas that typically were CFPB territory, not on a broad scale, but a little bit, and it is worth paying attention to.
Yeah, no, some good points there. And actually, I applaud the FTC for some of their actions. I mean, Chris Mufarage, who runs the Bureau of Consumer Protection, worked for Kathy. I know Chris. he's a good consumer protector, and he's fairly knowledgeable of industry. But I say I was shaking my head largely, Joann, not in disagreement with what you wish for and maybe hope for, but it's all about limits. I mean, with the OCC and the prudentials, they're absolutely limited. They can't really touch, for the most part, non-banks.
True.
And then the BCP, the Bureau of Consumer Protection, has all of like 375 people, so it's significantly smaller than even the greatly diminished half bureau, if that happens. So it's difficult for them to step in and fill. I mean, listen, they're trying, and I know they want to, and they absolutely want to go after bad actors. And that was true with like Tom Ward, who was one of the enforcement folks under Kathy. I mean, these folks of both political stripes want to go after bad actors. They do want to protect consumers. I've yet to meet anybody from the Republican appointed side who just came in and said, consumers, I'm over them. The hell with them. Let's do things for the expense of big business, and let's stick it to the consumer. I mean, the ticket fees for the FTC. I mean, that absolutely was a wonderful lawsuit to deal with an abomination in plain sight. Every time you looked at a ticket, you couldn't, the fees were horrendous. So I hope they keep doing that good work. I just don't think the FTC got its wings clipped. How many years ago was that? Significantly clipped. Even if Congress wants to throw more money at them, which they probably don't, for that reason, that they felt like once Republicans felt like the FTC got too full of themselves.
There's no political cachet at the FTC. Well, there's a ton of political cachet for whatever reason at the CFPB.
This is my day to disagree with you, Joann.
Okay.
It's think about Rohit at the CFPB, at the FTC, and think about Lena Khan at the CFPB. Absolutely, some of those commissioners realize there's enormous political cachet. And then if you look at FCC with what's his name, Carr at the FCC, I mean, it's a political thing a day with that guy.
That's the FCC. I'm saying between the FTC and the CFPB, the cachet was always at the CFPB. Remember when the CFPB was stood up, what they were paying people was so much more than the FTC that everybody was running over to the Bureau. So, having, nobody in Congress is standing up and waving a flag for the FTC, but for some reason the CFPB is their divine champion. So.
Yeah, no. Listen, I agree with you that the CFPB was the brighter, shinier object, and it hurts me that, I mean, I wish every director was sort of like followed a career track. Well, I would rather they follow a career track where they become a lobbyist than a politician, because again, you have the grandstanding. I mean, no consumer ever benefited from a freaking headline. And I look at like $8 credit card late fees. Okay, huge headlines for Rohit, but where is that now? I mean, if it had been something that was less headline worthy, like $15 or $18, hell, that might have survived. And quite frankly, consumers would be benefiting, responsible industry would be benefiting, and we would all move along. So anyway, but the other thing, a reconstituted bureau at like 554 folks, the quickest way to do that is to jam up as many politicals as you can, maximize politicals, and at the same time, fellows. And so that's not a good hiring path for really good technocrats. It's more like fuel on the fire of radicalization.
As you know, we're delving into the federal regulations, and if the feds kind of move down the path, then suddenly you have the states coming in. Virginia just came up with all their new debt collection rules. Maine, which again, you kind of wonder, what is Maine doing? But without having the way to divulge, if you're saying, okay, well, in Maine, we're going to do this, in Virginia, we're going to do this, in California, we're going to do this, the Shield Act in New York City is going to make us do that. You're going to have such a large legal staff just to do business, to lend somewhere, is the rules and regs are just going out of control. Now I noticed in California, they just Armand just got passed by the California Senate. Everybody approved him. Does that mean the CFPB, since they pulled somebody that actually came from FinTech, that understands the industry better than, let's say, the DFPI has known or has tracked for in the past. Is that a better way to go so that the DFPI suddenly becomes, I'm not going to say industry friendly, but more industry friendly than where they've been? So I turn this over to you guys again to kind of pose the question is, how do we deal with 54 different states, territories, etc., that are all want a piece. They all want a piece of the pie. They all want to find people. They all want to go down this way to where they think they can get money. But also they want to have the power and the control. California, is anti-federal because Trump's in charge. New York, the same thing. Again, the pendulums in the states has swung the opposite direction, even though 3 years ago, under the Biden administration, it was the opposite.
Yeah.
So how do we deal with this?
Well, for one thing, Armin Meyer in that position that's some reason to hope. He's a bright light. In my mind, he's kind of a Raj Date class, a public servant, and that
Exactly.
he's deeply grounded in industry. And at the same time, he is also a fierce protector of consumers. So you have that balance. He's not somebody that's coming in absolutely uninformed and trying to save consumers from evil financial services firms without knowing anything about the market. He's going to go in and he's going to approach it in a very intelligent fashion. Doesn't always necessarily mean measured. I mean, some of you may have witnessed Tom Paul. I think it was an ACA event where they forgot that Tom Paul was a regulator. And I mean, he clapped back at the audience that seemed to be trying to get too chummy with him. Again, Armin is a law enforcement officer, as was Raj Date when he was the deputy of the bureau. But I'll tell you what, I'd much, much, much rather have a highly educated, highly informed, multiple degreed law enforcement officer than Barney Fife, or I'm trying to think. I'm trying to think of another darker example than Barney Fife, because it is a darker outcome if you've got a very uninformed, very radicalized consumer regulator.
Yeah, well, that would probably come back to not that I want to beat up on New York City, but New York City was not really realizing the repercussions of coming up with a rule. What's actually going to happen to the industry? I mean, I'll revert back to the payday loans where, hey, we'll just get rid of payday loans and stuff. Again, not thinking that someone's just going to go across the bridge and get a payday loan, or they're going to go down the illegal path of, bringing back, Guido, the killer pimp, to go ahead and borrow the money from. That's kind of what you're looking at. How do you fix something that, again, everybody thinks they can fix it, but the reality is if everybody's going to make their rules and regs, we're more messed up than we know what to do with.
Well,
Yeah.
I would say that, to your point, Steve, it's not, look, a lot of these rules to some degree and licensing issues have been around for several years. The issue that I'm seeing, and Stefanie, I think, is seeing this too, is selective enforcement. A couple of years ago, issues with licensing, or even not that they were ignoring the rules, but if there was a problem, they would deal with it. Now, all of a sudden, everything is a problem. All of a sudden, licensing issues that were not a big deal when an application came in, all right, fix it later, are now, if you don't fix it now, you're not getting a license. It's just become an issue of now we're just going to enforce everything and be difficult. And I think, unfortunately, for a lot of these states, it is very short-sighted. I mean, look, we saw this several years ago when New York, with DFS, when they changed their debt collection rules. What happened? Litigation increased 20%.
Right.
So there'll be consequences for what New York is doing right now. There will be consequences for licensing. I have many clients, as I'm sure Stefanie does, that are looking at jurisdictions and saying, you know what? Cost of doing business, not doing it. Cost benefit is just, it's not there. And this is all about money. Licensing fees are about money. Of California, it's going to be about money. And, not that debt collection licensing is going to be the thing that's going to put California in the brink of a budget disaster. They're all, they're doing that on their own, but everything adds up. Everything adds up. And I think it is just, it's foolish, because there is still, until consumers do not have an appetite for credit, which, let me know when that happens, it's a credit economy, and people are still going to need money. Money is still going to need to be collected. And if you keep putting up guardrails, we have said this for years, and advocates are like, yeah, it's going to squeeze credit. Well, guess what? It's now squeezing credit. It is absolutely squeezing credit. When you've got to fill up your cards, $90, which I did last week, I was like, whoa, it is going to be a problem. People are going to need those credit cards to fill up their cars. They're going to need it for groceries. And if you keep squeezing credit this way, you are putting a large population of people in really dire straits. And to your point, they're going to go to other areas that are not regulated by the state of California or the state of New York.
New York City proposed rules are absolutely, that case in point. It almost feels like New York City took all of the dumb ideas that didn't make it into Reg F, that were just dismissed as being like problematic, and they shoved them into the rule. But and on that vein, I'm trying to organize volunteers for my campaign of door knocking for digital, where people will go to New York and they will knock on doors, because it's legal to knock on doors, and ask them for permission to digitally contact them. I mean, it doesn't take a genius to realize consumers would much rather deal with an email or an SMS than a call from a debt collector, AI or otherwise. It's like, making that impossible does get more expensive, right? It flies in the face of what everybody wants now, both political sides: affordability.
That's 100% true, because if you just make stupid rules, then you're going to get stupid results, and there's just no way to do it. But again, what was the reasoning behind it? They want to make a statement. They want to make something new. Here, we're gonna fix everything, and then everyone will follow us. And it didn't take the industry long to just look at it and say, well, this is just stupid. It doesn't make sense. It's not going to work. And you're going to end up, if you put on a loan in New York City, you're just going to sue them, because that is really the only way to collect on it. Because if you can't use a debt collector to go after them, then you use an attorney and you sue them, and that's the way it is. And the cost of business in New York is going to go up.
And at the same time, as much as I dislike those rules, it also is a call to arms about maintaining your relationships and your ability to engage, your ability to get in the room and actually have civil conversations about the downside for consumers, and building trusted relationships where they don't assume that everything that you say that seems somewhat pro industry has to come at the cost to the consumer.
Cost to
That's
the
not always
consumer.
the case.
Right. No, I definitely say that. What about like in this let's throw out the city of Chicago out there as well, because Chicago just basically went through. We ran the article all about how Chicago's over $8 billion in the hole of monies owed, and Chicago says, "Hey, we're handling collections great. We're doing a great job." I mean, there's a prime example where the private sector couldn't hurt the city of Chicago. If Chicago is so dead broke and can't do anything, and they don't have any money, yet there's $8 billion owed, and they're not collecting on it, although they say they are. Here's a prime example where the industry could easily walk in and say, let us help you fix it. Let us collect some of it, and let's help turn it around so you can do it. Otherwise, you're going to have, if it's $8 billion today, it'll be $12 billion by the end of the year. It'll be $16 billion down the road. And it just keeps growing and growing and growing. And that's just money that's never going to be collected.
We have federalism, but we don't have municipalityism. Okay, it's made up that word.
You heard it here first.
I like that word.
Yeah, I like it, Stefanie.
Right? No,
I like that word.
It's hard to say. I don't need to have it. And but at what point do we start thinking about how far can municipalities within a state go? Oh, and by the way, if a municipality goes too far, And I think New York City has done that in several ways. But coming back to New York City, to illustrate how this could also impact somewhere like Chicago, it's one thing to say, like Chicago does, you have to get a collection license, and if so, then you're subject to Illinois' Collection Agency Act, and they may impose like one or two other little things. Buffalo, Yonkers, right? They're just bringing in parts of state law. New York City is going a lot further and beyond state law. And one of those areas is saying that if you give somebody any kind of language support service, at least is how I read it, then you need to send them a validation notice in that language. And if you send them a validation notice in another language, including Spanish, because the CFPB made it readily available for you, right? And everybody has chosen to use the model form, which they have not. As much as the model validation form is helpful for some types of credit, it can be challenging for others, especially when you come out of a traditional third-party FDCPA debt collector rubric, which is what New York City is doing. But if I send you a debt validation notice in another language, I also have to provide everything else in that language. I have to do complaint, dispute, and resolution in that language. I have to give settlement letters in that language. I have to do all these things. So I have clients saying to me, what do I do? I'm like, well, hope that New York City clarifies that they didn't mean to go quite this far, because it is not possible to provide that level of support if you give like language access line, a language line service. So you need to stop. If you can't do that level of support, then you need to stop in New York City, but you can't just stop in a municipality. You have to stop statewide. And I bet you money that the New York Attorney General's office and New York DFS is not trying to have people stop offering language line access statewide, but not stopping statewide risks fair treatment issues. This is why municipalities really shouldn't be going, in my humble opinion, they should not be able, whether it's from a legal construct or just being practical, to go further than state laws. You want to raise some revenue by requiring additional licensing, reporting, and oversight that you can then collaborate with your state regulators on, fine. But we weren't set up as a nation of cities. We were set up as a nation of states. And that's where I think preemption really needs to come in, or some other legal construct, because otherwise, you're exactly right. This is going to proliferate even further. And I'm hearing rumors, maybe one of you knows, about some county in Maryland that has decided to launch its own.
San Diego.
Or I didn't know about San Diego, Joann. But yeah, so this is already happening. I'm hearing in Maryland, there's some county that has gone off and created its own CFPB-esque county level thing, whatever's going on in San Diego. That's going to be real problematic. And when my clients call me and say, what do I need to do? I default to, you can't just exclude a municipality. You're going to have major fair treatment. And if you're a lender, fair lending issues, possibly, right?
Mhm.
So you can exclude the whole state. Are states prepared to let that happen? Is New York prepared to let that happen? I don't think so.
Yeah, I'm kind of curious what folks in Buffalo and Yonkers have to say about what New York City's doing.
Right. Well, I will say, it just came out this morning. I don't know if you guys, I haven't read it yet. The whole Cantero case got decided by the Second Circuit. And that was a situation where New York State was mandating that national banks have to comply with their mortgage escrow interest calculation, whatever that may be. That went up to the Supreme Court. It then got punted back down to the Second Circuit, and the Second Circuit said, no, New York, you can't do that. That is preempted. So, that is, a sliver of a little win. But Stephanie makes a great point. And I will say, last week she did a great session at about preemption. It was awesome. And she's right. I mean, it is, it's one thing if you're in a state and they have certain speed limits because you're in the state, right? You can follow 55 seconds.
That rule, yes.
Right. You're in a state and your property taxes are X because your property is there. Okay, that's what your property taxes are going to be. But for financial services, I'm a huge preemption person. I mean, at this, especially even today and even 10 years ago, but maybe not 20 or 30 years ago when I was first starting to practice, we didn't have cross-border. But you could only bank at PNC, which was only in Pennsylvania. There was no PNC in Florida, Maryland.
Right.
This is an industry, and unfortunately, most industries are cross-border now, but this is an industry especially that is cross-border. You cannot have state-specific rules. And it might be a nice segue because I know, Steve, you want to talk about AI. I mean, the disaster that is Colorado and trying to have their own AI laws, that, you can't, how am I going to comply living here in Utah is ridiculous. I mean, it is just penny wise and pound foolish, and it is creating serious disruption in trying to offer service to consumers, helping consumers when the people who are providing those services have no idea what the heck or hell they're supposed to be doing. But I think that moving forward in the next couple of years for our industry, it has to be a battle about preemption. Preemption has to exist with what we do, period. I mean, you can have state
violent agreement.
You can have penalties, whatever, but actual conduct and the delivery of services cannot be state specific. It's impossible. It is
violent agreement with you on that one, Joann. I could not agree. I could not. Finally, right? We found common.
If you guys are parallel, there you go. That you've got.
Here, I got my little gritty toy. Yay.
Yeah. Hey, what do we want? We want foreign investment. We want this to be a company that we want this to be the shining place that other countries want to invest in. And how do you invest in something where the rule of law is just this muddled, messed up, crazy quilt of I don't even know what. And it, this is going to sound extreme, but there could even be national security implications around there. No, you know what? Forget the could.
Think about data centers.
There are national security
50 miles down the road.
Right. Where the feds need to do this. They need to have control over this for a number of reasons. I mean, the reason that this country, one of the reasons that we're so successful is we do draw investment, right? Because the rule of law is sound and predictable, and all of this stuff undermines it. And the other thing that really irritates me about some of this stuff, you triggered a rant, is there are the ghosts and the echoes of Operation Choke Point in debanking kind of everywhere. Where, you know what, debt collectors, I don't really like that business, so let's make it harder for them to operate. Let's go ahead and put our revenue raise on the backs of debt collectors or debt buyers. And you see that all the time, right? You saw that with marijuana banking. And there was a case recently where, it just has to stop. If a business is legal, I don't care about your dainty sensibilities. They sell pornography, but it's legal. Okay, you have no business deciding that you're going to try to cut them off from the banking system. You don't like to eat gummies. Well, that's you. You do you, I'll do me. Although I do get the sort of debanking-esque around marijuana banking because the feds haven't fully said they're never going to pull the rug out from under it. But there's so many other businesses that I think face this because they're looked down upon. Even though they're operating legally, and debt collectors have always suffered this. That's why in deregulatory times, it never gets nicer for debt collectors.
Yeah. Lumped in.
No, that's 100%
the pornography
true.
industry, the marijuana industry, debt collectors. It's just all in the same breath. We're the bad guys.
Well, the gambling industry. Look how they turned it around. Now, sports gambling has become such a big business. And sports used to, they used to punish people for gambling, and doing that. And now, they encourage it. You can't turn on a sports thing without looking at sports gambling. And not that I'm opposed to sports gambling. I'm not, because I enjoy that too. But everything is within, reason.
Yeah, I am, but I am opposed to it. I think it ends badly. But I also think that if it's legal, no one has any business trying to make their banking hurdles higher because they just don't like it.
Right.
Kind of morality fines, and in the lines of technology and trying to regulate technology, kind of circling back on Colorado and what
And AI, yes.
Yeah, and AI, what they're trying to, I like to perk my ears up when we start talking about AI, and you think about, like we were talking about, how state specific AI laws, how difficult is that, right? As a technology company to say, well, if it's in this state, then the AI behaves differently or something like that. That even Europe versus the United States, the European GDPR,
GDPI,
right? That companies in the U.S. a lot of the times we'll follow GDPR because we don't know if we might have someone from Europe that's using our tools and services. And the same
Here's
thing
a
can go for AI.
here's a real big problem on the AI front, and I don't have a solution. We don't have any sort of construct right now for arguing that state law should be preempted on this. The president's executive order is I mean, I'm sure he would disagree with me, but if you look at it legally, it is not enforceable to require states to not legislate and regulate in this area. We need Congress to pass some sort of nationwide privacy bill or AI bill. And I mean, good
Good
Lord,
luck.
that
With
wasn't
a council
Yeah.
on that.
power.
That,
Although,
and when,
data privacy though, okay, I'm usually more hopeful than not, but when it comes to data privacy, like there is bipartisan support for that, right? So maybe that we could get there, but you're exactly right, Stephanie. We need to act now before we basically like just completely put ourselves at such a disadvantage globally around the use of AI, where consumer uses are absolutely completely fettered and muddled, and uses for killing people, like in the military, aren't. What a weird dichotomy.
right, when you look at what the Colorado AG is basically saying right now, I mean, is he throwing his arms, up in the air saying, "Oh my God, I can't even enforce this because how do I?" I don't know. Everybody just kind of says, "Well, wait a minute. If just because you make a law that is unenforceable, how do you enforce a law that you can't?" And so, the feds probably do need to step in and say, "Okay," because AI is where is AI not in an industry right now? I mean, it's everywhere. I mean, everybody's using it for efficiency. They're using it for their technology. They're trying to get ahead. They're trying to cut every expenses, go through the process. So how do you regulate that? And the answer, I have no idea how you could regulate it, but I know right now the way it's set up, you can't regulate it until somebody comes in and says, okay, here's what you can do and here's what you can't. And but how do you enforce that over state boundaries?
Yeah.
Don't know.
Which is where Congress comes back. I think this is a repeating theme for these four is, yeah, if just like with the CFPB, if you can get a reasonable Congress to pass a reasonable rule, and now you've got a reasonable consumer friendly but also industry aware regulator. Same thing could be the objective with AI ruling. If we can get both sides to agree on something, privacy wise, like John said, or just some kind of guardrails that we can all agree on, then we're going to be in a better place. And then hopefully then some of the states might back up a few steps, slow down. But then again, I don't know. I think there's blood in the water, and maybe this is just the first of many.
As Joanne said, it becomes politico, and once it becomes politico, one side says yay, so immediately the other side says no. And you can't manage like that anymore. You've got to basically come somewhere in the middle and say, all right, we have to come up with something to make it work. Otherwise, it's not going to work, or it's the wild, wild west. And then if it's the wild, wild west, who knows how that's going to end up? You don't know.
It takes
Well,
leadership, and we just don't have great leaders. And until there is good leaders that people want to follow for the right reasons, then you could potentially, make these changes. But the AI situation is a Herculean task. And it's going to it's going to take a lot of political capital. And for a lot of people, they don't want to invest in that political capital because the downside, there's more downside than there is upside.
And Congress has just not been Congress for a long, long time.
Way before this administration.
If you're seen shaking hands with the wrong person, oh golly.
When's the last time you really looked at Congress engaging in the people's work without looking over their shoulder towards the White House, right? I mean, there's way too much of that where they're not doing the people's business. They're doing the business of someone else, or they think they are, or they're doing it against that person. And again, Rob, I loved what you said, and I'm more hopeful than not, but that was downright Pollyanna-ish. I mean, I wish we could get there. We did. It's almost like we don't act on things until something really bad happens, and then we knee-jerk it as a country, and it's exhausting.
Yeah.
I agree. We've kind of hit on the states. We've talked a little bit about the feds. We've kind of, run our gamut in the past hour, which is really where we're at right now. Is there anything else you guys want to toss out there that we need to chat about before we go? And John's already raised his hand.
We gotta give some love to our sponsor,
Yeah.
CSS, today, right? We gotta remind everyone that that's who's paying the bills for all of us folks
Yes,
to talk to
we
each
do.
other. So thank you,
absolutely.
CSS.
Yes, we are so grateful for that, and thank you, Rob, for that announcement. No, I was just going to say, that the CFPB's complaint report came out, and this is absolutely a rant. In the midst of all of the crazy, it sort of gets hard to, like, the Bureau. Everything the Bureau does is politicized now, and when they came out and wanted to create a speed bump for the complaint process around credit bureau accuracy, everybody's like, oh my God, they're throwing consumers under the bus. But I mean, 6.8 million complaints, like doubling every year. I mean, the complaint system of the CFPB is completely hijacked by credit repair companies and finfluencers who may well be funded by credit repair companies. And listen, that is a business. Like, listen, there's a place for payday lenders. There's absolutely a place for debt collectors and debt settlement and all these other players. But credit repair is of dubious utility to a consumer in the bright light of day. I'm sorry, but badgering a accurate but negative information to be taken off your credit report to move yourself from a mid subprime score to a slightly less mid subprime, there's no value in that, and we're letting that happen. And like I said, I think that I'll give it to Jeff Gradler and the folks at the CFPB. Putting something in there to create a speed bump to slow that crazy down was absolutely the right thing to do. I hate that it's been so vilified, as and cast is throwing consumers into the mouths of wolves.
No, I actually, if we just published that on the industry trends on the newsletter, and we tend to grab those big reports and put it on. So if somebody's got an extra half an hour to go through that and just kind of glance at it, you can definitely go on there and take a look at the report, because it's you need to read it, you need to understand it. If you're going to complain about it, you better understand what's being published and what's being said.
And relevant to this group and most of our, what I presume is most of our audience, I may have told you this. I had a call from a reporter a few months ago that wanted my insight on a story about bill collectors going crazy and bad. And it was around the complaints about threatening to ruin credit. And when I started digging into the numbers, I mean, it really looked like the credit repair organizations had just added a new feature to the direct and indirect disputes. And then traditionally, they often tell them to file a complaint with the CFPB, but they said, let's make it sound like a worse complaint. Let's say that you were threatened, that the collector threatened to ruin your credit. And in many cases, I think no one had ever talked to the consumer, and they sure as heck didn't put it in writing that they were going to ruin their credit. But again, that was a case where the reporter was disappointed with my opinion. I said, this isn't a tale of collectors gone rogue. It's a tale of credit repair organizations continuing to behave in a rogue fashion with impunity.
I'm going to make a quick comment on the CFPB's fair lending revisions to Reg B. There's been a lot of talk and a lot of concern from consumer advocates that this is, a reverse direction. There's going to be more discrimination. And there certainly were aspects to Reg B that were revised, but one aspect that was not, and one part of Reg B that was not, was the issue of discouragement, which was the whole Townstone case. Basically, what the CFPB left intact was that Reg B could apply to prospective applicants, which is a very nebulous term. And surprising to me that they did leave it in there. And don't be surprised when there's a new CFPB sheriff, or when the CFPB comes back, that is going to be a huge area that they are going to focus on, discouragement of prospective applicants. So I don't think that there has been so much talk that Reg B has been gutted. I'm not so sure about that. Now, will this CFPB take up that cause and bring enforcement actions? I don't think so, but they certainly have laid a path for future, more aggressive CFPBs to do that. So stay tuned on that issue.
Would like to be getting somewhere sometime soon, but I think there's a lot of uncertainty and you know what? To be positive, like John, lots of opportunity, right? So opportunity to engage, opportunity to flag issues, opportunity to let different constituents and interested parties just understand that when they're intending to accomplish A, they could inadvertently be accomplishing B. And, we'll see how that works out for consumers.
All those wonderful unintended consequences that New York is going to get to learn all about. That digital and AI and all that is what I like to think the most of that. And so what New York did, right, that a disaster for digital communications, not good, right? Not good for technology. Same with Colorado, that's trying to go out on their own. And that I'll just repeat it, that it seems like maybe a preventative action of actually getting some reasonable guidance in place from a federal level might be a preventative against some of these, but who's to tell? Who knows if that would even work?
Well, we'll kind of hang tight and see how the headlines go this month before we're in that there. We have our homework internally to do a little on what everyone's thinking about, and then we'll be back next month talking about all the issues that keep coming up. I do want to toss out the headline that did grab a lot of people's attention, that the CFPB fined Synapse. They went crazy, and they fined them a full $1 for not maintaining records and stuff. And everybody kind of scratched their head, and they got a lot of clicks because people saw, wait a minute, they fined them $1. Why would they fine them $1? Because in this day of multi-million-dollar fines, the dollar is an interesting way to approach it. And I'm going to toss this over to John because I know he's just itching to throw that out there and talk. We'll end on the dollar. But I do want to say thank you again to CSS Impact for sponsoring the podcast. We will be back again next month talking to our friends and followers on this podcast. But John, you get the last word on the dollar fine.
Yeah, no, I think my reaction to that was, my gosh. I was quoting an American banker some months ago about it was sort of a paint by numbers way for a fintech to screw up, and I think a black eye for partner banking. And again, so much good has come from fintechs and the concept of partner banking, and this was such a bad example. I think earlier I might have ranted to somebody that I thought Adam Sandler in the movie Uncut Gems did a better job of protecting his customers' assets than Synapse. I encourage folks to read that thing and just watch what happened, because it is absolutely outrageous. I think that's a bad signal to send, especially when it's one of there haven't been that many public enforcement cases over the partner banking model. And those kind of cases where they're righteous are ways to actually sort of usher in and sponsor a better, more stable industry. And so, I just said I agreed with some of the things that the CFPB's done, but that's not one of them.
You gotta like it when John's not happy with the CFPB. There's an issue.
That is a big problem, right?
That's
it just occurred to me during this session. I wish when I was at the CFPB, an industry would come in and rant about us, that I would accuse them of suffering from CFPB derangement syndrome. I think it's real.
There you go.
Take
I like
after when you
that.
go back, John.
That's a lot of acronyms. That's a lot of acronyms.
Thanks, Joann.
You're welcome.
All right. With that, we're gonna call it a wrap right now. That's a great way to end it. We'll see you guys all next month. We'll put it together. And with that, we are adjourned. Take care.
Have a great week, everybody.
Thanks, everyone.
Take care.